Welcome back, everybody, to another episode of Multifamily Report. I'm your host, Travis Watts. This series is dedicated to market news, industry updates to help you, the multifamily investor. In today's episode, we're talking about rising interest rates and what you can do to help protect yourself against them. So there's a lot of talk about interest rates throughout 2022 and what's going to happen in 2023. And while nobody, including me, including the Federal Reserve, has a crystal ball, nobody can effectively predict the future, what we can talk about is what you do in multifamily apartments to help preserve capital, increase your net operating income, and to help combat these interest rates. So to kick this episode off, generally speaking, the higher interest rates go, the more negative implications there are on real estate at large. But we do have to dissect this a little bit, and we have to look at what type of real estate are we talking about. So let's start out by talking about the example of single-family homes. So with single-family homes, the higher mortgage rates go, the less purchasing power a buyer has. So if we back up a year ago, and let's assume for example purposes that someone bought a single family home at a 3% interest rate and the cost of that home was $600,000. So their mortgage payment would be effectively in the ballpark of about $2,000 per month. Now fast forward through today, if someone was getting a 7% mortgage rate, as rates have increased, they could only afford a house that's $380,000 if they wanted to keep their payment the same. It would still be in the ballpark of about $2,000 per month. So this has a negative implication on two sides. First of all, that buyer who's shopping today at a 7% mortgage rate might be priced out of homes above $380,000, so there's less inventory for them to choose from. Second, due to interest rates going up so quickly, sellers may have to discount their prices and come down to meet the buyer demand or to attract an offer. And since single-family homes are primarily valued on comparable sales that have occurred nearby within the neighborhood or within a short distance, that means that we're likely to see prices decline, and that's what we are seeing nationwide in many different markets. Now, as we turn our focus to commercial multifamily apartments, there's some similarities, but there's a lot of differences. And so the similarity would be, of course, when mortgage rates go up, they go up for multifamily as well, which is a negative implication and might lead to a lower purchase price. That's true, but there's a few things that you can do to help offset that risk. The first thing to mention is multifamily apartments that are pre-existing, meaning that they already have residents in place today who are paying rent. Rents tend to go up with inflation. And right now, as a nation, we're running really hot inflation at 40-year highs. That's helping justify the rent bumps, which is effectively adding value back to the properties. Furthermore, if you're investing in a value add business plan within multifamily, which means that you're renovating units, you're making the place newer, nicer, safer, and of better quality, let's say, that helps to justify the rent increases even more, adding to the net operating income on the property. And unlike single-family homes, commercial multifamily apartments are primarily valued off the net operating income because there's not always a comparable property to compare it to. So take, for example, there's a 400-unit apartment complex in Orlando, Florida, built in 2010. Well, surrounding properties might be 200-unit complexes built in the 1980s, or it might be 300-unit complexes that were just built a couple years ago and they're luxury and basically brand new. So there's really no comparable sales to look at, and therefore that's why the net operating income is so critical in finding your valuation. So now let's talk about commercial loans and how these differ from a lot of residential loans. First of all, if you're going to get an adjustable rate loan, which means that your rate that you pay is going to adjust up or down depending on what interest rates do, you can buy what's called an interest rate cap, which effectively is like an insurance policy, and it caps you out at a certain level. So let's say today you're obtaining a mortgage at 6%. You could get an interest rate cap at 7%. And that way, if the Federal Reserve says we're going to take rates all the way up to 10%, you're effectively capped out at 7, and you're not having to pay anything additional above that. That's one way to preserve equity and capital. The second thing you can do is you can obtain what's called an assumable loan, which means that a future buyer can take over your loan that's currently on the property. And the benefit to this, if you believe that interest rates are still going to go up higher in the future, let's say you're getting a mortgage loan at 6% today, and let's say in a few years they end up being 8%. Well, a future buyer in a few years could then have a 6% mortgage versus an 8%, which again helps preserve the net operating income on your property and helps justify a potential higher sale price. The third thing you can do is you can obtain an interest-only long-term loan. And when I say long-term, it's a lot different than residential single-family homes. A long-term commercial loan would be like 7 to 10 years. So let's say you're going to enter into an investment, a multifamily investment, and the operator or you decide it's going to be about 3 to 5 years. That's how long it's going to take to renovate and to potentially sell. Well, you could put 7 to 10 years of debt, sometimes interest-only debt, on that property. And that way, when 3 to 5 years rolls around and you're ready to sell, let's say the economic conditions are not good. Let's say that the US is in a recession or whatever's going on in the world. Well, you have many more years that you can still hold that property and wait for a potential recovery and then sell at a more lucrative time. A final consideration on multifamily apartments during times of rising interest rates is, as we mentioned, the higher the rates go, the lower the potential sale price might be. This can be looked at as an opportunity to buy properties at a discount because multifamily properties are treated as an investment vehicle. So if you're in this game for the long haul, this is a classic example of being able to buy the dip. As I mentioned previously, nobody has a crystal ball. Nobody knows where interest rates are headed in the future, but let's examine the 3 possibilities that could unfold. 1, interest rates could come back down. If the Federal Reserve can get inflation under control, or maybe if the United States goes into a bad recession, they might cut interest rates temporarily. This could be an opportunity to refinance the deal at a lower loan cost, which would effectively boost the net operating income and could add a lot of value back to the property or allow you to sell at that point. Number 2, let's say that interest rates just stagnate and they stay where they are for the foreseeable future. Well, you're buying at today's rates. You're hopefully implementing a value-add business plan. You're hopefully boosting the rents due to inflation and that business plan, and hopefully you can sell at a higher price than what you paid if rates don't change. The third option is, what if rates just keep going up, up, up and away to who knows where? Well, you could implement some of the things that we talked about earlier on the type of debt that you put on the property, which could lead you to have more flexibility and more options for selling at a better time in the future. So something to think about if you're investing in multifamily apartments moving into 2023. Thank you for tuning into Multifamily Report. My name's Travis Watts. If you ever have any questions on this topic or any others on the channel, you can reach me at travis@ashcroftcapital.com. Have a great week, and thanks so much for tuning in.